Hello, Triple F family. Whether you're 20, 30, 40, 50, it doesn't matter. If you've never been in the investing game, today is your day. On today's video, we're going to talk about how to invest, how to get started, where to get started. And not only that, we're going to give how to get started, and we're going to give you what to get us started with. We're going to name ETFs. We're going to give you ticker symbols. We're going to give you all the information you need to get started. There will be no excuse not to be invested after today's video. So stay tuned next on Triple F.
Okay, what's up, guys? How's everybody? We're excited to be back. Triple F.
Triple F.
We have a good one. I'm really excited for this one. I'm actually when it's like taxes and stuff like that, I have a little bit harder time staying awake, but that's normal. It's taxes. But on this one, I want to hear this one because we're going to be talking about how you should start investing. This is like investing 101. This is like just getting off the starting blocks, taking the first steps, and then building up some good experience so that you can get a little more fancy with the way you invest later on. Yeah, what's up? What's going on?
So yeah, you kind of said it right. And this is just kind of getting in the game. You know what? What I hear a lot of times, you'll hear people on the news, you'll hear people out on social media. You know, the small guy can't get by. You know, how do you get in the game? Wall Street's for all the billionaires and millionaires and blah blah blah. And they use that as an excuse to kind of just not ever get invested. And if you ever want to get ahead in life financially, you've got to get in the game, because I'm going to give you a secret. All the millionaires and billionaires are in the game.
So yeah, at least to some degree, right? I mean, you've got different areas, different buckets you can invest in, whether it's real estate, sort of this would be considered like paper assets, right? This is like little components of big companies.
Yeah, we're going to talk kind of today really about how to get into the stock market for the first time, because that's where a lot of the money's made. But you can also diversify with real estate. But you know, you'd be surprised what we consider real estate. Real estate is equity in your house, and so that's actually real estate that you're invested in. So, but yeah, we're going to just talk a little bit about how to get in the game, because if you don't get in the game, you're going to sit there. You'll never be able to retire and become a millionaire or get a lot of money by investing in CDs and in your checking and savings account. It just isn't going to happen. And it takes as little as $25 a month. All it takes is a couple trips to Starbucks, maybe one less out to eat, and you're in the game. And so I'm going to give you some, not only advice on how to get in the game, I'm going to give you we're going to actually talk ticker symbols and some investments that you can actually start your portfolio with. And so stick around for that. With any approach, the first thing is you have to kind of build your foundation. And so what would the foundation be when you're beginning your investment? So we've talked about in past podcasts, you need to have an emergency fund. You need to have some available savings account money first. Okay. So before you can even start investing, you have to have that emergency fund, because we just want that in cash. We don't want to invest it. We just want that available, for when life happens to you. Second thing in building your foundation is paying off all your consumer debt. We've talked about that. No need to start investing in stocks or bonds or real estate until you have no more credit cards and probably student loans. Because if you're paying 18, 20, 25% to the bank, you're not going to make that in the stock market. And so that's your best.
You're always losing.
That's the best use of your money, is to pay off all those credit cards, high interest debt, we call it. So, get out of that, and then you free up a lot of income, and it's easy to find that $25, $50, $100 a month to start your investing journey. And the next thing you have to do is create a simple budget. We've talked about living on a budget. And so the only way you're going to know how much you can invest every month is to have a budget and have some ideas of where your money's going. And then set that money aside before you spend it on all this other stuff. And so if you do a budget at the beginning of the payday, you come down and you see, well, I've got an extra $100. Let me throw that in an investment bucket and go ahead and shoot that over to the savings account or to the brokerage account we're going to talk about. The money's there. Okay. And so you've paid yourself first, set that money aside, and then go ahead and spend on the rest of the stuff that you have in your budget. The next thing we want to think about is only invest money, because we're going to talk a lot today about investing in stocks and ETFs, mutual funds. Only invest money in these things that you do not need for a minimum of 3 to 5 years. Do not put, if you're saving for a car 6 months from now, do not put that money into the stock market, because as we found out recently, and how we find out at least once or twice every year, and big time every couple, 2 or 3 years, is that if you put $1,000 in equity funds or stock funds today, 3 months from now, it could be 7,000 or 700. If you put 10,000, it could be 7,000. If you put 100,000, it can only be 70,000. So unless you're comfortable with that scenario happening over 3, 6, 12 months,
Mhm.
you don't want to put that money in equities. If you're saving for something like a car, a down payment on a house, whatever it is, swimming pool, whatever it is you're wanting to spend over the next 12 months or so, put that money in cash someplace to where all of that'll be there when you need
Mhm.
it.
You know, the way I look at when I put money into like like a Fidelity account
Right.
or whatever, you want to, Vanguard, whatever it may be, is that I look at it like these are actual dollar bills that are like, well, little workers for you, right? They're
Exactly.
just
Yeah.
churning over there, trying to make as, a couple pennies for you, right? But and if you look at it like, hey, those guys are actually working for me, and so they're actually untouchable. I'm not gonna, they're like employees. I'm not gonna fire them, right? I want to keep them in there, keep them working. But whatever they make, that's what becomes eligible for you to actually sort of skim off the top or take off the top, take some
Yeah.
sort of distribution or something. But that's how I look at them. It's like as soon as you put them in, just kind of just say, hey, that's your working force. That they work for you.
Yep.
Just leave them there. Don't even think about them. They're just out there just churning and
No,
burning.
no, you're exactly right, and unfortunately, sometimes they go on vacation, so you have to plan for that.
Yeah, sometimes they get sick.
Sometimes they
They
get
break a leg every now and then. They die.
wow, man, that's like it can be brutal out there in the investing world.
Mm.
Well, anyway, so the first thing you're doing is you're building a foundation, seeing how much available cash you have to invest. The second thing I want you to really think about is before you start investing, develop just a basic understanding of investing. You don't have to be an analyst on TV. You don't have to be a stock guru. You don't have to be Warren Buffett. I mean, these guys get into all kinds of complicated stuff. We're just going to today talk about simple investing, how to get started, whether you're 20, 30, 40, 50, or 60.
Mhm.
There's 50-year-olds that have never put one dollar in the stock market. And so now they're interested. And so when we say beginning investor, we're talking about just now getting into the game.
Mhm.
So what are some of the couple different things that you want to think about learning before you get into here is a risk versus reward. If you just understand what is your risk tolerance, when I talked about putting 100,000 in, if it's 76 months from now, is that going to really bother you a lot?
Mhm.
Whereas if you hold out 3 to 5 years, that 100 may be 150 in 3 to 5 years.
Mhm.
And so, but some people can't take that as stomach
Yeah.
churning. I mean, some people that don't understand what's going on, you put 10,000 hard-earned dollars in there and you wake up 3 months from now, it's only 7 or 8,000. You really can start, your stomach just churns. You
And
can't sleep at night.
you know why? Like for me, I've thought about this a lot, and I've heard someone on. I won't get into who it was, but because I actually can't remember his name. But he said that for guys, we actually look at these accounts as like scorecards,
Yeah.
right? And when we see the money in our bank account and we see it growing every couple of weeks or every month or whatever, it's a reflection of the hard work, and
Yeah.
you're seeing it grow. But when you put it into some sort of brokerage account or stock account or something like that, you get a sense that you've lost a little bit of control, right? You can't control if it's going up and down. And so when you see it go down, you actually sort of psychologically or emotionally, you see it as a bit of a knock on your own,
Yeah.
like on your scorecard. And so you almost don't even want to look at it because you're just like, oh no, I'm actually going to feel bad if I look at it and it's going down.
So you talk to the greatest investors in the world, the Warren Buffetts of the world. Nobody has 1,000 is betting 1,000 in investing.
Mhm.
For every 5 stocks they pick out, 2 of them will go way down. One may stay where they're at, and you may get one that really takes off and makes up for everything else. And
Mhm.
so we're going to talk a little bit in a minute about diversification because it's important that you don't put everything in that next hot stock tip that you've heard about. So after you understand your risk reward, and you understand how risky you think you can be and still sleep at night. You want to understand the key investment types. And so now we're starting to get in. Do you want to invest in individual stocks? Do you want to invest in ETFs, which are exchange traded funds? Do you want to invest in bonds or mutual funds? And because they all kind of do similar things, but boy, the volatility is just, it's off the charts as you go down the line. If you have one stock, the volatility can be up and down 30 or 40% in a year, whereas an ETF or a mutual fund may be up and down, 8 or 10% in a year. And so, but with individual stocks, you can also get a lot of upside, if you get the right stock.
Mhm.
So it just depends really on your risk tolerance, but just understand the difference between what a stock is, what an ETF is, what a mutual fund is, and what a bond is. And then diversification, like we talked about, don't put your eggs in all in one one basket. If you hear the hot stock tip, ABC company is about to really take
Mhm.
off because they're going to invent the next AI robot.
Mhm.
Don't go put all your money in that, because if you want to play around with it, put it, a little bit of the money, 2 or 3% of your money or a percent of your money, that's fine. But don't put everything in the same basket. Don't, that's why I like ETFs. And you're going to see in a minute that's what I'll be recommending probably mostly, are ETFs, because
Mhm.
they're diversified over hundreds of companies. So, and it just really smooths out the returns and allows you to sleep a little bit better at night. So with that, and you mentioned a little bit about it, is how do I get going? Okay, so first of all, you have to pick a platform for investing.
Mhm.
You can't put money in your checking account and invest that in the stock market. You can't do it in a normal savings account in the bank. And so you have to pick, and we talked a little bit about it last week, I think, what's called a brokerage account. And so a brokerage account is really like a money market account. So it's really, you put money into the brokerage account, and that's kind of, and you can write checks against it, you can invest with it, you can buy stocks with it, but just with it being in a brokerage account versus a checking account, it opens up the world of investing to you. The big companies I stick with: Fidelity, Vanguard, and Schwab. Those are my favorites. I stay away from some of the smaller ones that really, like, day traders. They don't
Mhm.
mind you trading 200 and 300 times a day and all that, because it's when things get rocky in the market, I like to know that I've got a huge company behind my money that's going to
Mhm.
be there if I need to take it out. Some other ones that are coming up: SoFi, Robinhood, those are probably okay. They're not as big, I don't think, in the stable as Fidelity, Vanguard, and Schwab. Those are kind of the three big ones I like. There's other ones, T. Rowe Price. There's a lot of them, but pick one. I use Fidelity mostly. I've used
Mhm.
Vanguard, but pick one, and you go online and you basically set up a brokerage account. It takes 10 minutes. You fill out a little application, send a wire transfer in for $100 or $1,000, whatever, and
Mhm.
you're in. You can start buying stocks.
Mhm.
So, and you may, what I did is, if you work for somebody who has a 401k, they probably already have a platform. So the
Mhm.
company I was with, we used Fidelity, and so naturally all my 401k money and pension was in Fidelity. So when I got ready to open a brokerage account, I just went and opened up Fidelity. That way it's all in one
Mhm.
company and it's all consolidated, and you get kind of one statement at the end of the year, each quarter. Oh, but I want a very large company. I want somebody that when you get the financial crisis of 2008, they're going to be there in 2009. So,
Mhm.
and your money's going to be there. And I stay away from all the small players that do all this hype trading stuff. So that's kind of the first thing. The next thing is, what type of accounts do you want? Okay, and so you may already be invested, not even realize it a whole lot. But if you work and you have a 401k or 403b, if you work for a public or for a hospital, or in the education, you already have a workplace savings account. Problem is, a lot of people don't pay attention to that. So they have
Mhm.
all this money on this 401k, and
Yep.
I ask them, well, what is it invested in? Well, I don't really know.
Yep.
And so if you don't know, then the first thing you want to do is get involved in that platform, in that account, and really start managing that a little bit and making sure it's in stock funds. People sit there for 20 or 25 years in bond funds or cash when they could have been in stocks all this time,
Mhm.
and it just made all the difference in the world. So
Also, we weren't quite aware of this, but even for like your 403bs, which would be for like your
teachers and
teachers and so
hospitals, yeah.
forth, that they have managers that you can contact
Mhm.
within the school district or the hospital, and they'll actually walk you through exactly how it's invested, and they'll talk to you about what you should do and what you shouldn't do, and and so there are resources available. It's just that most employees just don't know that they just think, oh yeah, okay, I'm supposed to take advantage of my 401k so I can get the match. So you sign up for it and then you just leave it there until you leave the job, and that's
Yeah.
the next time you think about it is when what am I going to do with my 401k? If even then, sometimes people just leave jobs and just don't even remember that they actually signed up for a 401k program.
In all of these companies, Fidelity, Vanguard, they all have online resources that you can
Mhm.
call, you can talk to somebody. Edward Jones does a good job locally of helping teachers,
Mhm.
with some of their investment options. So if you have no interest in investing and you really don't like it, don't just ignore your 401k or 403b. Get some help in there to help you
Mhm.
get it, because if you look 20 or 25 years from now, if you've had it invested in just really conservative bonds or stocks, I mean, you could have been 4 or 5 times higher balance if you'd had the thing
Mhm.
in equities
Yep.
over time. So pay attention. It's your money, it's your future.
Mhm.
You're not working for nothing. You're working for a future. So pay attention. The other account types other than 401, 403b are Roth IRAs. I always tell people to invest in Roth IRAs. You can put like $7,500 a year in that.
Some
Uh,
people would tell you to do that even first.
yeah,
Like,
yeah,
do that
yeah. So if
because
you ever look at our wealth order of operations, it's kind of 401k matching amount first, and then Roth IRA after that, and
Mhm.
then you kind of finish out your
Yeah,
401k, what you can put in that because they all have limits
yeah,
as to what you can put in them.
and tax advantages
Yeah.
are
And then
crazy.
and then brokerage accounts. With the brokerage account, which I mentioned, there's no restrictions on income or withdrawals. You can put as much in there. You can make as much as you want. There's no tax breaks for it, but it's the tool that you will use to buy equities, to buy ETFs, stocks, mutual funds, bonds, whatever it is you're wanting to buy. You have to have this brokerage account set up. And so
Mhm,
it's just like I said, it's like a checking or savings account, except it has access to all these investments. So
mhm.
you have to have that to get started in the game. So now you've got that. So you picked a platform, you've got an account, you got a brokerage account set up, you got $10,000 in there or 50,000 or 1,000 or whatever it is. How do I,
What do you
how do
do?
I start investing? Now I've
Mhm,
got that. What do I do? Because it's just sitting in cash right now.
mhm.
So first thing you want to do is you want to make sure you invest regularly.
Call David.
Yep, call me. Invest regularly, and you want to automate those contributions where available. So all your 401ks are automatic. They come out of
Mhm,
your paycheck. They go into your 401k. If you have a brokerage account, you can send a couple $100 over there a month or $100 a month or whatever from your checking account to your brokerage. And then we want to start with large index ETFs or mutual funds. That's what I always recommend. Your first investments are in a large index exchange traded fund or mutual fund. When I say index, something that tracks the S&P 500, Standard& Poor's 500, or tracks just this total stock market. Okay, and there's different types there. And now we're going to get into the weeds a little bit, and this will be up on the screen. But we want to start. The different buckets are: you have aggressive growth, which is your most aggressive investment. That's people that have a little bit higher risk tolerance. You have things like the QQQ, which tracks the NASDAQ 100 stocks. You have SPYG, which is the S&P 500 growth fund, and it tracks the highest uh, volatility or the best companies in the S&P, the technology companies mostly. When you see aggressive growth, you're probably going to be talking more about companies in AI, the technology companies, the ones that
mhm,
are they don't pay dividends. They're just all about growth. It's all those Mag 7 they talk about, the Googles, the Amazons, Microsofts.
mhm,
It invests in all of those in one big basket, and it's a very easy way to invest in that. Just
mhm.
buy QQQ or SPYG.
Spy G.
Now, you're not that stomach churning. You want to go down one little notch. You can do what's called growth instead of aggressive growth. Now, it's just like some growth stocks. That's your S&P 500 index, and so that's investment in the 500 biggest companies that make up the
Mhm,
Standard& Poor's 500 list. It invests a weighted average amount in all of those stocks, and all you got to do is buy a share of SPY, and you have a little piece of all of those companies, all
mhm,
500 companies. And so that one pays a little bit of a dividend. It's not as aggressive as QQQ or SPYG, but it's just called SPY, and it's the SP 500 index fund, and it just tracks that index.
mhm,
Okay, so when you look at investing tracking uh, ETFs and what have you, when you look at the Nasdaq, it's more tech heavy, and so that's what QQQ tracks and SPYG, and so the Nasdaq just is more technology heavy, and it's just more aggressive. When you look at the SP 500, you have a lot of companies like Walmart, Costco, a lot of the companies that aren't quite as aggressive as those tech companies. They pay a little bit of a dividend, but they're huge. And so
mhm,
when things go south in the market, I like having big companies because they're going to make it through. So now you've got the aggressive growth, you've got the growth. The next step down is what we call growth and income. And so these are companies that they grow, but they're also paying a dividend. They may be paying a 3, 4, 5% dividend. If these
mhm,
are energy companies, utility companies. These are some of your basic material type companies. It's your paper towel company, the ones that make paper towel, Procters and Gambles of the world.
mhm,
It's the banks, the JP Morgans. It's those companies that are growing and they're huge, but they also pay a dividend. Whereas in your aggressive growth funds, those companies are worried about growth. They do not pay dividends. But if you need some income, if you're getting close to retirement or in retirement, some of those dividend payers are good. And so the two ETFs I recommend there are VYM, which is a
mhm,
Vanguard kind of high yield dividend ETF, or SCHD, which is a Charles Schwab high dividend payer. So these are dividend payers. They're energies, financials, healthcare. It's all those types of companies, and so you'll get some income and you'll get some growth.
You know, there's a guy on YouTube that I like. The name of his channel is Daily Driven Porsche because he likes Porsches, right? So I like cars, and his whole philosophy, at least up until here recently, is that his whole goal is to buy enough SCHD to where he could have enough passive dividend income to be able to basically offset his income he
Mhm.
has right now, and he's like constantly pushing to be able to get up to that point where he's got that much in dividends. So, and that is a strategy you can employ, is to just only go into this growth area
Yeah.
with these dividends and just keep pumping into, these SEHDs
Yeah.
and stuff.
The thing you have to watch for on that is when you get all these dividends, understand if it's in a brokerage account, they're all taxable income. And so you do wind up
Mhm.
having to pay taxes on that. So when you have high dividend ETFs and stocks that pay a lot of dividends,
Mhm.
if you're getting $1,000 a month, or that's gonna be 12,000 more income, you have to pay tax on at the
Mhm.
end of the year. So,
Yeah, but he just
so
keeps pumping it
yeah,
back in.
so it's good. It's good to have just understand the tax
Yeah.
implication of that because they
Yeah.
also when you get these dividends, they don't withhold taxes to where you get to the end of the year. And I've seen
You're
people
like,
say
"Whoa."
all the time, oh, $6,000 in taxes. Well, where'd that come from? Well, you had 25,000 of dividends
Mhm.
this year.
Yep.
So you need to be aware about it. I love it. I have VYM. I love SCHD,
Mhm.
especially if you're not on the younger end, if older end, close to retiree. These are the ones you want to kind of start moving towards. And so I
Close to
love both of those.
retirement.
I love both of them. And then the last one there's international, and I don't have a lot of international because
Mm.
really, if you look at the history, the U.S. market will outperform these international markets probably 8 out of 10 years. Every now and then, the international markets, which this past year has been one of those times, but the international markets will outperform the U.S. market. But it usually doesn't happen very often. We have kind of the
Mhm.
biggest, baddest, I would say, the biggest, baddest companies in the world right here in the U.S. And so
Mhm.
I tend to keep most of my investing domestics. But those are the kind of the different buckets: aggressive growth in income, a little international for the stock portion of your portfolio. There's also bond ETFs, and we'll get into this a little bit in a future podcast. I'm going to give you the difference. I'm going to go a little bit more in depth on the difference between stock funds, bond funds, what makes them move, stuff like that. But for now, I'm focused really on this presentation on kind of getting in the stock game, because if you haven't been in before, you're in the front end, you're going to want some growth. And so with bonds, you don't get a lot of growth. You get more income, but not much growth.
Mhm.
With these stock funds, you're going to get growth and a little bit of income along the way. So I recommend that, especially the younger you are, you're going to be skewed towards that aggressive growth end and probably zero in bonds. But as you get down the road a little bit, you get 50, 55, you're thinking about
Mhm.
retirement. You want to start throwing
You
some
wanna be
bonds in there.
insulated a little
Yeah,
bit.
and throwing some of that growth and income stuff in there. So what are some of the pitfalls? I mean, there are when you invest in stocks, there are a lot of pitfalls you can fall into, and I've just tried to. I'm going to try to highlight just a few of them that you really have to be careful about because you have to have the
Mm.
financial emotional capacity to handle the stock market because
Mhm.
if not, you're going to get cooked. I mean, it's going to be a terrible bloodbath. So, the first thing you have to think
Mhm.
about is you have to think long term. You can't think daily. You can't think monthly. You can't even think quarterly or annually. You have to think 3 to 30 year time frame. Warren Buffett says it the best. When I buy a stock or buy a company, I'm buying it for the next 25 or 30 years. I don't care if the stock market closes for a year. I'm not worried about the daily stock
Mhm.
price movement. At some point, if it's a good enough company, the price will catch up to it. You have to remember companies don't follow stock prices. So if I'm working at Microsoft, I'm the CEO of Microsoft. I'm not reacting to every wiggle in the stock price. What will happen over time is if the company's good enough, the stock price will follow the company. Okay, it'll find out where it needs to be. But stocks go up and down for many reasons, and usually not very good reasons, and sometimes no reason at all. Just if there's a sector out of favor, every stock will go down no matter how great the company is or how bad the company is. And so you have to be really able to handle these swings. But the way I get past all that, I can't compete with the daily traders. So I think longer term, if I hold it long enough, all those wiggles work their way out. So
David, would you say that, like, looking at thinking long term and making sure you've got emotional maturity, would you say that there are certain personalities that will do better with this than
yeah.
others? In that a lot of the people that you mentioned, whether it's Warren Buffett or pick whatever stock investor, typically they have a certain demeanor and personality
Mhm.
that sort of ties, I think, closely with being successful with the stock market. You wouldn't be somebody who's like just sort of emotionally erratic. That's like, sort of goes with whatever whim that may come about. You see some flashy thing, you go out and buy it immediately. That doesn't tend to be the kind of
Right.
personality for someone who's sort of built or wired to be in the stock market. Would you agree?
Yeah, oh, yeah, absolutely. So I can kinda give you a few of those traits. So you don't want a riverboat gambler. You don't want the guy that's gonna, that goes and plays craps, at
Yeah.
Vegas on a regular basis and spends half his paycheck.
Mhm.
You don't want somebody that where their life is kinda disorganized. And so
Mhm.
if you're not the kind of person that's somewhat organizing your thoughts and organizing your day-to-day stuff, if you get excitable really easy or you get
Mhm.
depressed really easily, you don't wanna be in the stock market because your emotions will go up and down with the stock market.
Mhm.
And so you really wanna be somebody that and probably the biggest one is that you need to understand what you're investing in, okay? So
Mm.
if you just go into this with no knowledge and you just throw
Mhm.
$10,000 in something, you have no idea what makes the stock market go, what you don't keep up with the news, you don't know, it'll drive you completely crazy because as recently, we get in this war with Iran, I mean, the market's gone down 15% in the past 2 months just as we've gone to war. We come out and we talk about in the war. Now it's going to go. It's probably going to shoot right back up. But the more you understand, the more you keep up with current events, and the more calm you are about this stuff. Yeah, I think you have a better shot at it. Uh,
Mhm.
and it takes experience. So the longer you're in it, the more of these downturns you've seen. I've lived through 2000, I've lived through 2008, and both times, I got my master's degree and I got my PhD in investing during 2000 and 2008 because I learned so much during those two downturns, where you lose 50% of your portfolio in about 6 month period. And so
Mm.
yeah, I think just experience, a calm demeanor. Don't get excited. Don't get too high when the market's up 1,000. Don't get too low when it goes down 1,000. And if you ever look at a short-term chart, like a 3-month chart, and you see that you've cratered, just pull back a little bit and pull up a 10-year chart, and you're gonna say, "Oh, but over the last 10 years, it's done, it's way up."
Yeah.
You just have to really, watch yourself. I never sell on huge down days. I never buy on big up days, and so that just kind of is my own kind of edict. If the market's way up, I'm not gonna go be buying stuff because you really wanna
Mhm.
buy stuff on sale. You
Mhm.
really wanna look forward well, I kinda got you wanna look forward to the times the market goes down because that prevents sales.
Say
Stocks
right
don't sell.
now?
Right
Yeah,
now is a
this
great
this is
time
a good
'cause
correction
yeah, this
territory
is
right
this is
now.
this is April 1st, and it's no April Fools, but today is a
Yeah.
good time because 'cause we're down 10 to 15% in the Nasdaq, right, as
Yep.
of today. And
I'm
so
gonna get on
there
my
you go.
Fidelity account right now.
Okay, because it will go down sometime, possibly down 50%. I've had 2 50% corrections in my life, so investing life. So
Mhm.
don't try and time it. Don't panic sell. Don't invest in get rich quick schemes. Remember, investing is a crock pot. It's not a microwave. You're not going to be, if you want a microwave, play the lottery, go to Vegas. But when you invest in stocks, it's a crock pot approach. You're not going to double and triple your money in the next month. Okay. It'll take 5, 10, 15 years to double and triple your money. But if you're looking for to get your vacation fund bundle, really going jacking up here over the next 3 months so you can take a big summer vacation. The stock market is not the place to be because it is not a get rich quick. It is a get rich slow and
Mhm.
steady.
Can I tell you a quick
Sure.
little funny story? So this is I'm gonna tell on myself here, right? I don't know if I've told really anybody this, maybe my wife only. So this one day, it was years ago, right? But it was still when like AI was like really in its infancy, so not that long ago. Anyway, I was like watching this YouTube video, and Elon Musk was doing some presentation, right? And he was talking about this new cryptocurrency that he was backing, right?
The
And
Dogecoin or
no,
something?
it was an
Dogecoin?
Ethereum. It was an
Oh, Ethereum.
Ethereum one, right? But and so he was pushing it, right? And then there was a QR code that came up on the
Uh-huh.
screen.
I
And I was
remember
like,
that.
"Oh, okay, I'll check it out." So I like clicked on the QR code and I just started to like go down the process. Guess what I found out?
What?
It was completely dubbed over. Like they had used some AI to get it to look like it was Elon. It
Oh,
even sounded like Elon, but it was a scam. They were trying to get you to push money into this account, this brokerage account or trading platform, and then they basically would take the money from you and then just run because you would have pushed the money in there based on something that they basically forged for Elon. And I was like, wow, that's what you have to be careful on, like
AI can
following
be
stuff like
dangerous.
that,
AI can
right?
be
Be
dangerous.
careful.
So, I mean, stock market's been around over 100 years, probably 125 or 30 years, big time, and all the easy stuff's been found. So, I mean,
Hmm.
but I like to tell people, I'll get them all the time. People say, "Well, hey, I read the news today, such and such. You think I ought to buy that stock?" I said, "Man, if you read it in the news today, that stock's already run if it's any good. You're not.
Hmm.
There's no news that we're gonna know."
Yeah.
first. So, because anything you're reading, somebody already knows
Oh,
it, and the market reacts in instant time. As I'm trading 100 shares, somebody else is trading 10 million shares at the same time.
Mhm.
So there's really no secrets. There's so many analysts. There's just no secrets. That's why invest in these ETFs,
Long
mutual
term.
funds, big stocks, and then just long term and let them go. The only way you're going to beat these guys is time. You have time
Yeah.
when you're set. They have to trade quarterly because they have to, produce
Yeah,
returns
yeah.
for their investors, or they're going to pull money
Yeah,
out of
they
their
got a
funds.
job
So
to do. That's their
yeah,
job.
and so the only way I've been able to beat these guys is just time's on my side,
Mhm.
and sometimes it doesn't work out. So, like I said, not every stock works out. So sometimes your investing thesis just doesn't work out. So, but I'd say don't invest in an individual stock unless you have a true understanding of how to research and understand stocks. You have to have that emotional capacity we talked about. And the biggest one of the biggest mistakes I see people make is they withdraw from their 401ks or their IRAs
Ooh,
before they're
can
59
get a
and a half.
penalty.
A crisis comes up in their life. They have
Mhm.
to have this and they have to have that. They're out of money. They go and they take money out of the 401k. They pay a 10% penalty. They pay 25% tax. Sometimes all over, they're paying 35 and 40% money on something that
Mhm.
they didn't have to do. I'm not saying never withdraw from your retirement accounts, but unless you're bankrupt, unless you're going to be filing bankrupt in court the next day, really don't draw. That temptation is out there. Just don't draw money, but it's so easy to do, but just don't draw money out of any of your retirement
Mhm.
accounts until you're 59 and a half. That 10% penalty is real. Those
Mhm.
taxes you're going to pay is real. It's a
Mhm.
huge amount. I mean, I'd rather you charge on a credit card because you're only paying 20% interest on that. This, you're paying probably 35 to 40% when you draw something out of your retirement account. The retirement accounts are for a reason. The government gives you those tax advantages for a reason because they want you to use that in retirement one day.
Yeah, the skeptics would say that this whole thing is rigged and they're just looking for people to cash out early, right? So that, I mean, the IRS gets
Yeah.
that 10%, they get all the taxes from capital gains. I mean, they are making bank every time you make a stupid decision.
They
So they're
are,
just
man.
sitting there waiting like, "Oh yeah. You need it. You need to draw that out. Go ahead, go for it.
And
You
and
need it."
and it could take you 10 or 15 years to get $100,000 in your
Mhm.
401k account. I mean, if you really put some money to it, it's making me and by drawing it out, you've taken 10 or 15 years of hard-earned
Mm.
savings and just thrown it at whatever it is,
Giving it
whatever
away.
crisis is in your life at that point in time.
Yep. Yep.
So what are the next steps, man? What are the things you have to do as you leave this video today? You have to open a brokerage
I
account.
want to go spend some money right now.
Open a brokerage account, Fidelity, Vanguard, Schwab, or any of the other ones we talked about, and invest. Put some money in there. Contribute to your retirement plan. If you're not in there, get in that 401k. If you're in there, and you don't know what it's in, go find out what it's in. Make sure it's in the
Mhm.
right things. Make sure it's in stocks. Talk to somebody that knows what they're
Oh
talking about.
yeah.
If you qualify for a Roth, open that Roth and get invested in that Roth. Invest in stocks, ETFs, mutual funds. Set up automatic deposits. It should already be automatic in your 401k, your 403b. If it's not, you need to get those automatic. Increase them to the max if you can, and set up automatic deposits to your brokerage accounts just so you
Mhm.
can start investing. But you can invest for as little as $25 a month in a mutual fund. So that's how I started back in like the 1980s or 90s. I started with $25 a month at
That
T.
was
Rowe Price
so
in a
long
mutual
ago.
fund. Yeah, that was
$25 back then was like
you,
$100.
you probably didn't think the market was around back then when I was investing, man. That's
Nope.
like I always say, back in the day. And so, but set up
Back in
automatic
a
deposits.
couple
And
days.
then the number one thing, leave it alone and that is
Mhm.
the key. Leave it alone and let compounding work. I mean, compounding is the Warren Buffett said it before. I know I've quoted him a lot because he's just the greatest investor of all time, but compounding is the greatest tool that an investor has. If you don't have to do anything.
The eighth
Just
wonder of the world.
just put the money in the account, put the money in those ETFs.
Mm.
Let the market work for you. Every time you see an Amazon driving outside of your house, a
Mhm.
big smiley face, I got a piece of that because I own QQQ. I
Yeah.
own
It's those
SPYG.
dollar bills
Yeah.
working for you,
And
just
so
churning and burning.
that's right. When you have eight Amazon boxes up on your front porch that your
Mhm.
spouse ordered, just think
Yeah.
that's profit that you're making because Amazon's make
Mhm.
money. Your ETF's going to go up. So
Yep. I agree.
that's what I tell my wife anyway.
Just
So, honey,
put it in there, put it in the stock market, and just do not take it out.
do not take it out.
Only think about the gains as what you're gonna take out. Just leave those bad boys
You
in
haven't
there.
lost money till you cash out.
That's right.
And so that's it, man. I mean, if you're not ready and pumped up to go
I'm
invest,
ready. I'm ready, especially right now with the market right now. You should be going in there, setting up your brokerage account, and get yourself in there.
15 minutes set up a brokerage account, maybe overnight
Easy.
to get the money in there, and then you can start investing it tomorrow or the next day. So,
Yep. Cool. Good one.
all right, man.
I knew it would be a good one.
Yeah, that's all
Yep.
we do here is Triple S. We just do good stuff.
Good
Man.
stuff. All day, every day.
All right, man.
Okay.
Until next time, this is Triple F. Check it out.
See you guys.
Happy investing.